Hey everyone, and welcome back, Focus Learners. I am absolutely pumped for today's explainer because we are embarking on a true masterclass. Today, we're taking Southside bank shares, ticker symbol SBSI, and we are putting it through the ultimate valuation gauntlet. We're not just looking at your standard everyday metrics here. No, we're going to stress test this company by applying the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, right alongside some hardcore discounted cash flow modeling. It's like a financial obstacle course. Let's see if this stock has what it takes to survive the scrutiny of the masters. Okay, let's dive into this. Here is our roadmap for today. First, a company snapshot. Then, we look through the Buffett lens, followed by the Lynch lens and the Graham lens. After that, we'll hit the DCF and alternative models and wrap it all up with our synthesis and final verdict.
Starting with Section 1, Company Snapshot. Before we can apply the mental models, we need to establish the baseline facts for SBSI.
So, what are we looking at? Southside Bank Shares is a regional bank holding company out of Tyler, Texas. It's sitting at a market cap of roughly $1.04 billion with a current share price of $34.84. But the thing you really need to pay attention to right out of the gate is that dividend yield. At 4.10%, it offers some serious cash-in-pocket potential. I mean, it vastly outpaces Texas peers like Cullen/Frost and Prosperity Bank Shares. This essentially sets SBSI as a classic, rate-sensitive community bank. They make their money the traditional way: deposits, consumer and commercial lending, and wealth management across their 53 local branches. It's a very localized, very traditional banking story. Moving to Section 2, the Buffett lens, we are seeking the moat and the margin of safety. As Warren Buffett famously says, he wants a wonderful company at a fair price. He's looking for that economic moat, consistent owner earnings, a high return on equity, manageable debt, and an intrinsic value that is heavily backed by a margin of safety. We have to be incredibly strict here. Does SBSI actually fit his criteria? Let's just walk right through his checklist. First up, the economic moat. I've got to classify it as narrow. It is heavily concentrated in Texas, which is a fantastic market for sure, but it completely lacks national scale. Earnings consistency, well, it's kind of mixed. They reported a solid $23.3 million net income for the first quarter of 2026, but their full year 2025 net income actually dropped 21.8%, down to $69.2 million. Next, return on equity is sitting at 8.4%. This is exactly where Buffett might hesitate, because he typically targets 15% or higher. But on the flip side, looking at debt, the bank is exceptionally well capitalized. They have a 12.87% CET1 ratio, which, if you're unfamiliar, is basically a top-tier measure of a bank's core financial strength against its risks. That easily covers their $239 million in subordinated notes. But when you combine that mixed earnings consistency with the lower ROE, Buffett is going to demand a serious discount to get involved. So, the crucial point is price. If we calculate approximate owner earnings using their net income and then slap a standard 20% margin of safety onto their historical value, our models show Buffett likely wouldn't even bite on this stock unless it dropped to around the $28 mark. At almost $35 today, it's just a bit too pricey for the Oracle of Omaha. All right, Section 3, the Lynch lens. Let's look at growth, PEG, and categorization. Now, Peter Lynch's philosophy is a bit more flexible. He wants a story that simply makes sense at the current price. He asks us to do a few things: categorize the company, check the PEG ratio, assess the balance sheet, and monitor insider and institutional behavior. Let's walk through these steps for SBSI. First, category. This bank has an unbroken dividend record stretching all the way back to 1970. That makes it a textbook stalwart or a slow grower. It's incredibly stable and reliable. Second, the PEG ratio, which is price to earnings relative to growth. The bank's forward PE is an attractive 10.25. Now, if we assume a normalized long-term growth rate of roughly 5% based on their historical revenues, our PEG ratio comes out to about 2.0. To put that into perspective, that means you're essentially paying twice as much for their growth rate as Lynch would prefer. He typically wants that PEG number at 1.0 or lower for a screaming buy. Finally, while our specific source documents omit real-time institutional and insider buying data, we know the balance sheet itself is robust, completely backed by those solid capital ratios we just talked about. Bringing that all together, Peter Lynch would very likely rate this a hold. He'd definitely appreciate the impeccable 50-plus-year dividend history and the rock-solid balance sheet, but that PEG ratio of 2.0 simply lacks the fast growth discount or the turnaround catalyst that he loves to uncover. Moving on to Section 4. The Graham lens.
the defensive investor's gauntlet. Benjamin Graham's approach is the absolute ultimate stress test for a bank's balance sheet and valuation multiples. He cares strictly about hard numbers and asset protection. If a stock survives Graham's gauntlet, you know it is fundamentally cheap. And this brilliantly illustrates just how tough SBSI actually is. Let's enthusiastically tick off these boxes. Adequate size? Pass, with a $1.04 billion market cap. Strong financial condition? Pass. Total risk-based capital is an incredibly high 18.54%. Earning stability? Pass. They just posted a highly profitable Q1 2026 with $23.3 million in net income. Dividend record? An easy pass, completely uninterrupted since 1970. Moderate price to book? Pass. It sits comfortably at 1.22x. SBSI passes almost every single one of Graham's defensive checks. And because it passes those defensive checks, we get to use Graham's famous intrinsic value formula. Grab your calculators, folks. We are taking the square root of 22.5, multiplied by SBSI's trailing 2025 EPS of $2.29, multiplied by its book value per share of $20.52. When you crunch those numbers, you get an intrinsic value of $38.33, with the stock currently trading at $34.84. It actually offers a roughly 9% margin of safety. For a strict Graham disciple, this stock is quietly undervalued right now and warrants some serious attention. Let's step away from the gurus for a minute. Section 5, DCF and Alternative Models, Projecting the Quantitative Future. We are diving into the raw, quantitative world now. For a bank, calculating traditional free cash flow is notoriously tricky, so we explicitly use net income as our proxy. If we input a standard 10% cost of equity, our WACC, which is essentially our required rate of return, and project a conservative 2% terminal growth rate to reflect long-term inflation, these inputs map out to a calculated fair value of exactly $37.33 per share. But look at this sensitivity table. Notice the extreme sensitivity of a bank's valuation to interest rates here. Watch what happens if the Federal Reserve changes rates, impacting the bank's WACC. If the cost of equity rises to 11% in a higher rate environment, fair value plummets down to $33.50. But if it drops to 9%, fair value rockets up to $42.50. Rate sensitivity is literally the absolute core of the SBSI story. In validating our DCF math, the alternative models align perfectly. 5 Wall Street analysts polled by S&P Global have a consensus average price target of exactly $37.33, with a consensus hold rating. Furthermore, looking at comparable models, SBSI's forward PE of 10.25x sits materially below the averages of its Texas peers like Cullen/Frost and Texas Capital, suggesting it's actually relatively inexpensive. Finally, Section 6, Synthesis and Final Verdict, bringing it all together. Let's move to and see how this builds our final picture. Graham is the lone bull here, right? His strict asset-based formula sees real, tangible value at $38.33. Our base DCF and the analyst average perfectly align around $37.33, implying it's fairly valued right now with just a slight upside. Meanwhile, Buffett and Lynch preach patience, wanting either a deeper discount down to $28 or a better growth catalyst before pulling the trigger. We have to concisely balance this final view. On one hand, the strengths are incredible. You've got this beautiful 4.1% dividend yield paid without interruption since 1970, fortified by a very strong 12.87% CET1 capital ratio. It is a highly sound institution. On the other hand, our source data highlights distinct risks. High exposure to commercial real estate, which is a particularly sensitive area right now given post-pandemic office vacancies, unrealized securities losses on their books, and that concentrated Texas footprint that ties them heavily to local economic swings. Taking absolutely everything from our masterclass into account, the final verdict for Southside Bank shares at today's price is a solid hold. It's a remarkably stable bank for sure, but it's not exactly a screaming bargain, which leaves us with a provocative question you really need to ask yourself. Numbers alone can't predict macroeconomic risks, so in an unpredictable Federal Reserve rate environment, is a 4.1% dividend yield truly enough to compensate you for those underlying commercial real estate risks? Think on that, and keep learning.